I'm on the floor of the New York Stock Exchange with Kenneth Polcari from ICAP Corporates. We're here today to talk about the market. Why don't you tell me a little bit about what's going on right now?
You know, we've had a lot actually going on right now between the macroeconomic data, both in the U.S. and international, as well as the political environment, the political theater that's been going on in Washington, D.C., as well as even in Europe, based on kind of the sovereign debt issues that are taking place over there. So there have been a lot of conflicting news items that have been hitting the market, and it's really all come together in a storm recently.
So would you say, is the market broken right now? What's to come?
No, the market is not broken. You might think after yesterday people may walk away and think the market was broken, but in fact all the market's really doing is it's reassessing the data. It's reassessing, it's taking control of the macro data which we've gotten over the last couple of weeks, which has not been, very strong, and it's allowing asset managers around the country, in this country and around the world, to actually reprice their models, input this new data into their models, and let the models spit out what they think the future really looks like and how they're going to assess risk. And so what we saw was some asset managers taking risk off the table, right? Liquidating some positions and raising some cash to reallocate. That's really what we saw.
And what would you say are some of the future long-term implications of a credit downgrade?
You know, from a consumer point of view, as Joe Q Public American, then the credit downgrade is potentially going to cause interest rates, to increase a little bit. We've only had this one downgrade. We're still a AAA rated country in Moody's and Fitch, and so this one downgrade is not going to be so dramatic. I think it was much more psychological than it really is going to be affect anyone's pocketbook. But you could expect slightly higher rates on revolving credit cards, slightly higher rates on auto loans or education loans, even on mortgages potentially. So those are the things that Americans should be concerned about. But from an equity standpoint or from a market standpoint, long term, the market, stocks are stocks, and if you're a long-term investor, 5, 10, 15 years out, this is clearly the place you need to be.
What are some of your expectations for the Fed later on today?
I think what we need to hear from Ben Bernanke is that he's got to acknowledge the fact that the macro environment is actually weaker than what they had been talking about. I think he's got to acknowledge that because the rest of us already realize that's the way it is. The next thing he's got to do is, without promising a QE3 program, because I don't necessarily think the country wants another QE program. He's got to offer assurance that in the event that things get worse than this, that the Fed stands ready, they stand pat, they are there to add liquidity and calm the markets. But beyond that, I think he just needs to talk about, if he acknowledges the weakness and acknowledges the fact that they stand ready, I think that will be what the markets want to hear. Yesterday, we did not really hear that from the president. We heard more of kind of the same, and the market has been telling us for the last week or so that it's tired, doesn't want to hear that anymore. It wants some leadership, and it really wants some direction.
So for future aspiration and for future hope, do you think things will start to look better and go towards a better direction?
I do, but it's going to be a while because, once again, we are entering kind of a soft patch in terms of not only the U.S. recovery, but really the global recovery. The market's kind of undergone some real stress over the last week and a half, and it's going to take time just to repair that. We've broken some key technical support levels, and it's going to take some time for the market to churn and build a base again from which to go forward. But I think once a lot of these asset managers understand what the future looks like, understand what the growth rates are, understand what the macro environment looks like, then, it will all settle down and we'll be back to really business as usual.
Okay, thank you very much.